Welcome to the deep dive. We're here to pull out the really crucial bits of knowledge, the things that help you get genuinely well informed. And today, wow, we're diving into a story that, well, it really turns a lot of common ideas on their head. We're talking about Nicolas Darvas.
Oh, absolutely. It's an amazing story. I mean, picture this. You've got a professional dancer,
Yeah.
right, totally outside the usual finance circles, and somehow he takes, what, $10,000, a pretty modest amount,
Yeah, 10,000.
and turns it into $2 million in just 6.5 years.
Incredible.
And get this, with zero prior trading experience, he actually laid out his whole system, this really unconventional strategy, in his book, How I Made $2 Million in the Stock Market. Famous book.
Okay, right. So let's break down how he did it. For you listening, our goal here, our mission with this deep dive, is really to give you a shortcut, a direct line to understanding his core ideas. We're going to boil down the most important advice, really unpack the basics of his famous box theory. The idea is, by the end of this, you'll be better informed, maybe see the market from a fresh angle.
Definitely. And the starting point for Darvas, it was all about mindset. A really big shift. The first key takeaway, you could say, is summed up in this phrase he used: kill your darlings.
Kill your darlings. Wow, that's blunt. Sounds dramatic.
It does, but it cuts right to the heart of a major problem. He talked a lot about the dangerous bias that comes from emotional attachment.
Like getting attached to a stock.
Exactly. Maybe a friend recommended it, or it was your very first investment, or maybe it's already made you some money. Those feelings, Darvas said, they just cloud your judgment completely.
So you need to step back, be objective.
He called it becoming an impartial diagnostician. Don't fall in love when it goes up. Don't get angry when it goes down.
Easier said than done, though, isn't it?
Yeah.
How did he actually manage that? Was there like a specific trigger or mistake that taught him this?
Oh, for sure. He learned the hard way. Early on, made some costly mistakes because of emotion. Hope, greed, fear, anger. They were the enemy. His rule became pretty simple. When in doubt, sell.
Just get out.
Yeah, he figured you get a much clearer view of a stock if you don't actually own it. No emotional baggage.
And selling isn't final, right?
Not at all. You can always get back in. Although, interestingly, the author of our source material, they mentioned they personally never bought back a stock after selling it with this kind of strategy. But the option's there.
Okay, so you've killed your darlings, you're detached. What's next? How did Darvas find the right stocks to even consider?
Right. That leads straight into takeaway number 2. Buy on strong positive trends and rising volumes. His basic belief was, look, if a stock price keeps going up and up, it probably means someone, somewhere, knows something you don't.
So piggyback on their knowledge.
Kind of, yeah.
Yeah.
Benefit from whatever good news or strong fundamentals are driving it, even if you don't know the specifics yourself. Just ride the trend.
And the volume part, you said rising volumes too. Why was that so important? Is it just confirmation, or?
It's crucial confirmation. Yeah. Think of it like this. Imagine, say, penguins. Penguins usually live in Antarctica, right?
Yeah.
Cold places. But suddenly you see a whole flock of penguins setting up shop on a tropical beach in, I don't know, Hawaii.
Okay, weird.
Totally weird. That sudden, unusual behavior, that massive shift from the norm, that tells you something significant is happening, something worth investigating.
Right, so a stock that normally trades a certain amount, suddenly trading way more alongside the price going up. That's the signal.
That's the penguin on the beach. It signals unusual interest, strong conviction, and the potential for that trend to keep going.
Got it. And Darvas wasn't just looking at the charts, the technicals. He had this techno-fundamentalist theory.
Correct. He combined those technical signals, the price and volume spikes, with a fundamental reason. He looked for improved earnings power. Often, he found this in new, vigorous infant industries, young companies shaking things up.
The fundamentals were the why and the technicals were the when.
Like a confirmation.
Exactly. The improved earnings, the new industry buzz, that was the underlying reason why a stock might move. The price and volume action was the market confirming that story. That's when he'd get interested.
He wasn't trying to, dig through reports to find the next big thing before anyone else.
Not really. He was watching how the market reacted.
Right.
And here's a key Darvas idea, kind of counterintuitive. His goal wasn't to buy at the absolute rock bottom price.
No, everyone wants to buy low.
Right, but he aimed to buy high and sell even higher. Jump on a trend that's already proven itself strong.
Buy high, sell higher. Okay. That definitely sets up the next part of the strategy then.
It does. Which is takeaway number 3, maybe the most famous investing advice ever. Cut your losses short, let your winners run. Yes. But this clashes directly with that old Wall Street saying, doesn't it? You can't go broke taking a profit.
Oh, that saying drives me nuts. It sounds safe, but Darvas called it counterproductive. Massively so. Because what does it make people do? They snatch small profits, quickly cutting their winners short, and they hold on to losers, hoping they'll recover, letting losers run.
Yeah. Win small, lose big. You don't have to be a genius to see that's not a winning formula. 5 times no. Agreed.
Exactly. It's a recipe for mediocrity. Or worse.
So, okay, cutting losses short. Logically, it makes sense, but psychologically, it's hard, right? Admitting you were wrong.
It's incredibly hard. It's ego. Nobody likes admitting a mistake, especially when money's involved. People cling to hope. They average down, digging the hole deeper.
So what was Darvas's practical tool for this? How did he force himself to cut losses?
The trailing stop loss. This is brilliant. It's not just a static stop loss order. You set a sell price, say 10% below the current price. But the key is, as the stock price goes up, your stop loss automatically trails behind it, always staying that 10% or whatever percentage below the peak.
Ah, okay. So it locks in gains as it rises, but protects you on the downside.
Precisely. It forces you to get out if the trend reverses significantly. It takes the emotion and the second guessing out of it. It's like that saying, if you find yourself in a hole, stop digging. The trailing stop makes you stop digging.
You need to set it wide enough, though, right? To avoid getting shaken out by normal little fluctuations.
Good point.
Yeah.
Yes. You don't want it so tight that any minor pullback triggers a sale. You look at the stock's typical volatility, how much it usually swings, and set the stop loss below that noise level.
And a huge side benefit, I guess, is market crashes.
Absolutely huge. If the market tanks, your stops automatically trigger as prices fall past those levels. You get stepped out without having to predict the crash, which is, let's face it, pretty much impossible to do consistently.
Okay, that covers cutting losses. But the other half, letting winners run. That's also tough psychologically, isn't it? Seeing a nice profit and just wanting to bank it.
It is. It's that can't go broke, taking a profit, thinking again. The instinct is to grab the money and run. But Darvas argued, look, trying to perfectly time the top, selling right at the peak, forget it.
Nobody can do that consistently.
Anyone who says they can is, well, probably lying or just got lucky once. If a stock is still in a strong uptrend, why sell? You have no idea how high it might go. Think about, like, the source used, H&M, during their big global push. If stores are packed, sales are soaring, everyone wants their clothes, why would they suddenly stop opening new stores?
They wouldn't. Not until things started to slow down, right? Like stockpiling up, stores getting empty.
Exactly. And that's when your trailing stop loss, properly priced, would naturally trigger. It forces you to stay with the winner until the trend actually shows signs of breaking down, not just because you got nervous or greedy.
So the trailing stop does both jobs. Cuts losers and lets winners run. It's the mechanism for both sides of that rule.
Perfectly put. And those two ideas, takeaway 2, buy strong trends with volume, and takeaway 3, cut losses, let winners run via trailing stops. They form the absolute bedrock of his box theory.
Right. The box theory. Okay, let's get into that. How does it actually work? Can you walk us through it, maybe with that example from the source?
Sure. He basically drew imaginary boxes around a stock's price range on his charts. The source used fingerprint cards, a Swedish tech stock. Back in March 2015, let's say it was trading consistently between 7 and 11 krona. That's your 7-11 box.
Okay, a defined range.
Right. Now, Darvas wouldn't buy it while it was just bouncing around inside that box. He waited. Then maybe in April, it breaks out of that box and starts trading consistently in a new higher range, say between 11 and 15. That's the 11-15 box.
So the breakout into the new higher box is the buy signal.
That's the buy signal. He'd buy as it entered that new higher box. And the bottom of that new box, 11 in this case, becomes his initial stop loss level.
Got it. And the rule is?
The rule is crucial. The stock can bounce around inside its current box. It can break out and form a higher box. But it must never fall back down into a previously established lower box.
So the bottom of the current highest box is always your trailing stop loss level.
You got it. As long as it keeps building higher boxes, you stay in, just raising your stop to the bottom of the latest box.
That's how he rode the winners.
Yeah.
And for fingerprint cards?
For fingerprint cards, according to the source, this method would have kept him in box after box going higher and higher until December 2015. At that point, it likely broke below the bottom of its then current box, somewhere around 110 krona. The trailing stop would have automatically taken him out.
And the result?
A 900% gain in about 8 months.
Wow, 900% just by following these boxes.
It wasn't magic. It just systemized his core belief. Stocks don't move randomly. They establish trends up or down, and those trends tend to persist for a while. His boxes were just a way to define and follow those trends rigorously.
Incredible discipline. Which I guess leads nicely into the next takeaway. How do you maintain that discipline and learn?
Exactly. Takeaway number 4. Create your own stock logbook.
A logbook. Sounds simple. Almost too simple.
Deceptively simple, maybe, but incredibly powerful. Just the act of writing down why you bought a stock and why you sold it, your reasons. There's that saying, right? A mistake repeated more than once isn't a mistake, it's a decision.
Yeah, good one.
A logbook forces you to confront your mistakes. Did you follow your rules? Did you get emotional? Did you listen to a bad tip? It helps ensure you don't keep making those same bad decisions.
So it's about learning and improving.
Constantly improving, and importantly, if you have your reasons written down, your logic clear, it makes it so much easier to stick with your plan when the market gets choppy or goes against you temporarily. You have conviction based on your own analysis.
That's like learning anything, really. Like the source said about driving a car.
Perfect analogy. You can't become a good driver just by reading the manual, right? You need to actually drive, make mistakes, maybe stall it a few times, learn from doing.
Get behind the wheel. Feel it out.
Same with investing. You learn by doing, and the logbook is how you analyze your driving, figure out why you swerved there or stalled here.
And better to make those mistakes early when the stakes are smaller.
Oh, absolutely. Making a mistake that costs you, say, a few weeks of summer job earnings when you're young, that's a cheap lesson compared to making the same mistake later and losing half your 401k. Learn early, learn cheap.
The source had some concrete examples too, right? Good and bad trades.
Yeah, really good ones. A successful trade in Ericsson, bought based on rising volume, strong trend, the whole 5G buzz, followed the rules, sold via the stop loss for a nice profit when the trend finally broke. Textbook Darvas.
And the bad one.
The cautionary tale. Buying General Motors purely because a cab driver mentioned they were working on an electric car. No real analysis, no trend confirmation, no stop loss used.
Ouch. How did that end?
Sold it over a year later for a big loss. And the logbook entry would basically say, reason for buying, cab driver tip, reason for selling, realized it was a stupid reason, should have bought Tesla. The log makes it painfully clear.
Lesson learned, hopefully.
Ah!
Okay, that brings us to the final takeaway, number 5. Be the lone wolf, stay detached.
Yes. This really ties everything together and speaks to Darvas's whole personality, maybe. He believed that to truly succeed, you can't be part of the herd. You can't be that confused, excited lamb milling around with others, as the source puts it. You have to stand apart, be the lone wolf.
And maybe being a dancer, an outsider to Wall Street actually helped him with that. He wasn't already immersed in that herd mentality.
I think that's a very possible, yeah. He wasn't preconditioned by the standard Wall Street groupthink. He saw clearly that all the noise, the chatter, the tips, the rumors, what he called input from your ears, it was mostly just interference.
Your ears are your enemy.
Pretty much. All that stuff. Interruptions, panic, conflicting advice. It just makes it impossible to stay calm, neutral, objective, impossible to keep emotion and ego out of it, which was his first rule.
And he learned this from experience too, didn't he, when he moved to New York?
He did. He'd been trading successfully from overseas using his system. Then he moves to New York. Thinks being closer to the action, the brokers, the experts will make him even better.
But it didn't work out that way.
Complete opposite. He admitted he started listening to others, got caught up in the Wall Street herd, abandoned his own proven methods, and that period became the least profitable of his entire career.
Wow. So being in the center of it all actually hurt him.
It diluted his focus and discipline. It's like,
Really?
why does Warren Buffett live in Omaha?
Right. Far away from Wall Street, deliberately detached.
Exactly. He understands the power of independent thought away from the noise. Our source had a great metaphor for this, too.
What was that?
Only dead fish follow the stream. Don't be a dead fish. Instead, be like a salmon fighting your way through fjords and rivers. You have to think for yourself, go against the current sometimes.
What a powerful image. And a fantastic way to round out this really fascinating deep dive into Nicolas Darvas. So just to quickly recap those 5 big takeaways: kill your emotional darlings, buy strong trends with rising volume, cut losses short, let winners run, probably using a trailing stop, keep a logbook to learn from your own experiences, and finally, be that lone wolf, stay detached from the herd.
Yeah, taken together, it's a strategy that really offers a unique way to look at the markets. It
Yeah.
challenges a lot of conventional wisdom, focuses on discipline, on trend following, on managing yourself as much as managing the stocks.
Definitely gives you a different perspective. So as we wrap up, here's something for you, the listener, to chew on. A final thought. Darvas achieved stunning success by questioning common wisdom and killing his darlings. So think about this. Where else in your life, maybe completely outside of investing, might you be kind of in love with certain ideas, habits, or beliefs that are actually holding you back?
Good question. What are your personal darlings that maybe need a second look? What could you achieve if you approach things with that same kind of impartial diagnosis Darvis used for stocks?
Something to reflect on. How might these insights from a dancer who cracked the stock market code apply to your own learning, your own decisions, in whatever field matters most to you?